which I know you are able to understand on that part, how a company can value is securities. You also understood on how the securities can be overvalued or undervalued. Now, the topic that I want to cover today is also related on valuation of security, is related on the securities. And today, I want to cover on the cost of capital. Cost of capital. Now, in this case, when you talk of cost of capital, is not the required rate of return by now the investors who have provided funds to the company. So in this case, we want to know how now, because we were able to now to get the value, how can we get now that required rate of return? That is the cost of capital. So let's just get to the cost of capital. So as I've said, when we talk of cost of capital, this is the required rate of return by investors who have provided funds to the company, who have provided funds to the company. Now, the cost of capital may include, we have number one, the cost of equity. We have the cost of equity. Number two, we have the cost of preference shares. And number three, we have the cost of debentures. The cost of debentures. So in our case here, on the equity items, we'll be basing on the ordinary shares. Ordinary shares, and also the what? The retained earnings. Retained earnings. So I said, when we talk of ordinary shares, these are shares that subscribe or the what we call the common shares. The members of this group, they receive dividend if the directors have declared that dividend. So they have the right to vote over their shares, and therefore they are having the control over the what? That company. Now, we also have the retained earnings. Retained earnings are now the internal sources of finance, like for example, the profits that this company retains. So the internal sources of finance out of the profit from the previous period is what we call in the retained earnings. Now we also have the preference shares. And I say for the preference shares, there are those shares that earn a fixed rate of dividend. A fixed rate of dividend, meaning that the dividend will be paid once these shares have been once in each and every period, because it is a must for them to be paid. We have the debentures, and remember in debentures I said we can also term them or call them the bonds, because in this case I said we have them in two categories. We have the irredeemable and the redeemable. Whereby I say the redeemable debentures are those debentures that do not have a defined maturity period. Now we have the redeemable debentures, the ones that are having a defined maturity period. So let's just begin on the cost of equity. How do we get the cost of equity? Cost of equity. Now, on the cost of equity, it is in two categories. As I've said, we have the cost of ordinary shares. The cost of ordinary shares. And to get the cost of ordinary shares, it will depend on the type of the ordinary share. Remember, I said we have the zero dividend growth rate ordinary shares. The zero dividend growth rate ordinary shares. So we said for the zero dividend is those dividends that once paid, they are paid at a constant amount. So the dividend that is paid in year 1 is the same dividend in year 2, the same dividend in year 3. That is what we call in the what? The zero dividend. So for you to get the KE, that is the cost of ordinary shares on a in case of zero dividend growth rate, ordinary shares will be equals to KE will be equals to the dividend PO minus the flotation cost, then you multiply by 100. Now, PO is what we were looking for, the value or what we call the market price of the security or the market value of that security. Now, we have the F. F is what we call the flotation cost. Flotation cost. Flotation cost is the cost that you incur when you are issuing the what? Like, for example, when you are issuing the ordinary shares. The cost that you incur in issuing the ordinary shares is what we call in the flotation cost. So you less them from there. Now, B, in case of a constant dividend growth rate, in case of constant dividend growth rate ordinary shares, to get the KE will be equals to the DO 1 plus G PO minus flotation cost, then you add the growth rate. I say DO is the last dividend that was paid. And when you take DO, you add the growth 1 plus the growth rate. This is the growth rate. This is the market value or the market price. This is the flotation cost. So I said when you take DO 1 plus G, you are getting what we call the next what? The next dividend. And therefore, KE is equals to, also you can see it's also, or it can be given by D1 over PO minus the flotation cost. Then you add the G minus the flotation cost, then you add the growth rate. This is when you are being given the next dividend, or what we call the expected dividend. Now, number B, this was number 1. Number 2 on the same, we have the cost of retained earnings. The cost of retained earnings. Now, retained earnings are said they are internal sources of finance which do not incur flotation costs. You cannot incur flotation costs when you are receiving profit, when you are accumulating profits. And therefore, in this case, the only difference with these ones is only that you are not lessing the what? Flotation cost. Like, for example, let me begin with the first one. In case of zero dividend, for you to get the KR will be equals to the D over PO, then you multiply by 100. The only thing that you are not lessing is the flotation cost. Reason being, retained earnings do not incur flotation cost. The second one is on the constant dividend growth rate. Now, on the constant dividend growth rate, for you to get the KR will be equals to the DO again, 1 plus Z over PO. In this case, remember I've said you are not lessing the flotation cost because you are not incurring the flotation cost. Or it can as well be given as KR is equals to D1, because this is now the next dividend, PO, then you add the growth rate. You add the growth rate. That is how you get the cost of retained earnings. Now, number 2, that is on the cost of equity. Equity in this case, I've said we're only measuring on those 2. Number 2, we have the cost of preference shares. Cost of preference shares. Cost of preference shares, we also call it the KP. To get the KP will be D, the dividend over VO, you minus the flotation cost, then you multiply by 100. And it's just as simple as that. For preference shares, they are not in any category in that part. So the next part is on the cost of what? Debentures. So you can first screenshot on this for us to get on the cost of debentures. Screenshot on that for us to get on the cost of debentures. Now let's get to that. We see on cost of capital. That is on the cost of debenture, stock bonds, the cost of debentures, stock bonds. Now, in this case, debentures have said they are in two categories. So we'll have Roman 1, the irredeemable debentures. So let's see how to get the cost of irredeemable debentures. I say the irredeemable debentures are those debentures that do not have any defined maturity period, meaning that they cannot be bought back or redeemed back by the company. So to get the KD of a redeemable debenture, you just take the interest 1 minus tax, you divide by the value of debenture. Remember, you can also incur costs in issuing debentures, and then you multiply by 100. That is how you get the cost of a redeemable debenture. Now, the next one, number 2, we have the cost of redeemable debentures. Redeemable debentures are said are those debentures that have a defined maturity period, meaning that they can be bought back by the entity. So for the cost of a redeemable debenture, you also term it what we call it the yield to what? The yield to maturity. The yield to maturity. So to get the yield to maturity or the cost of redeemable debenture, you get the interest 1 minus tax plus the maturity value. Maturity value is also the VAR value. Maturity value is also the VAR value minus the value of the debenture, which is now the current value, 1 over the maturity period. You divide by the maturity value, you add the value of debenture, multiply by half, then you multiply by 100, then you multiply by 100. By doing that, you will be able to get the what? The yield to maturity. Now, another part that we also need to analyze is on the WSEC. Because once you get to know how to compute the cost, you are also supposed to understand on the WSEC. Now, let me just have the notes here on the WSEC. Now, when we talk of WSEC, it is the overall cost of capital of a company, which we also call it as the average cost of all the funds employed by the company. So for the WSEC, it is used in evaluating existing projects. So when you see there, you are told that it is more relevant in decision making. Like for example, we've been told that it is used as follows. Number 1, those are also the advantages of WSEC. We've been told that it is an historical cost of capital, which is used in evaluating what? Companies' existing projects. When we talk of history, remember you are getting to the existing things. That is the future, the things that were there before. Now we also have, it is used in determining the cost of borrowing. So in this case, you will also be able to analyze why maybe the company may be preferring more debts than, or to have more debts than to have more shares. Because in this case, when you have the cost of capital, you will be able to analyze whether this company is able to borrow or not to borrow. Now, we also have, it reflects the general risk of the company. So when you get a higher value of the cost of capital, it means that the risk level is also what? High. So meaning that when you get the cost of capital being lower, that case again means that the risk of that company is very low. It's also used for comparison with other companies in the same what? Industry, and in this case is when you are doing the performance appraisal in regards to the company. And those are the advantages of WSEC. The advantages of WSEC, if you are as well asked about the WSEC. So for you to get the WSEC equals to the weight of equity. You add the weight of the cost of equity, basically is the cost of ordinary shares. You add the weight of preference shares, cost of preference shares, and then you also add the weight of debenture, cost of debenture. The weight of debenture, cost of debenture. How do you get these weights? The weights will depend on some values. It will depend on some values that are used to determine the proportion of weight in the capital structure. When I talk of capital structure, I'm talking about the long-term sources of finance that have been employed by the company. Like, for example, the debentures, the ordinary shares, and the preference shares. So in this case, we have, for example, like the market values. What I'm talking about here, you will have them in the notes. Now, the market values, they are the one that we use basically when we are computing the WSEC. The reason being, they do reflect the current market conditions. And where these values have been used, the cost of retained earnings, the KR and the WR, is ignored. Because already it is included on these values. And that's why in this case, we have not seen anywhere that I'm including the what? The cost of retained earnings. We'll also have the book value. Now, when you talk of book value, these are values that reflect the value of the capital when it was acquired. Basically, at the time that, like for example, is an ordinary shares, the time that the original value at that time they were acquired is what we call in the book value. So basically, they are just historical values that do not reflect the what? Current market conditions. Remember, for this case, they are reflecting the current market condition. For this one, they do not reflect because they are historical what? Values. Now, we also have the replacement values, or what we call the target values. Now, when we talk about replacement of target values, they are just projected values. So meaning that in this case, these ones are not popular because it is very difficult for you to predict in view of about the future. Because in this case, you have to keep in mind that security keeps on changing. And therefore, it will be very difficult for you to project or forecast the value of a given what? The value of a given security. And those are what we call in the replacement value. So by that, we'll be able to analyze the disadvantages on that case. So let's just have an example. In regards to the WSEC. And I will begin with the one for the previous sitting for November 2019, question number 1C. November 2019, question 1C. Excuse. Raised on November 2019, question 1C from the previous sitting. Which I love it here on the screen. Love it here on the screen. Question number 1C. And as you can see, been told that the current capital structure of Ahadi Limited is given as follows. We have the ordinary shares, and the VAR value is 10 shillings each. 10% debentures, we have 12% preference shares, shillings 20 VAR value. And on additional information, number 1, the current market value of the ordinary shares and the preference shares is shillings 50 and shillings 30 respectively. The debentures are irredeemable and have a market value of shillings 120 per shillings 100 nominal value. Nominal value is also the VAR value. The most recent earning per share of the company is shillings 6. The company currently adopts 60% dividend payout ratio as its dividend policy. However, the firm's future dividends are expected to grow at the rate of 7% each year for the foreseeable future. Corporate tax rate is 30%. You are required the company's weighted average cost of capital using the market value weights. Let's see how you are supposed to undergo about that question, or how you are supposed to compute that question. So now I've said to get the WSCC, you get the weight of ordinary shares, the cost of ordinary shares, you add the weight of preference shares, cost of preference shares, also add the weight of debenture, the cost of debenture. So in this case, what you begin with, you begin by on looking for those costs, the KE, KP, and the KD. So I will begin with the cost of ordinary shares. Now, in this case, I've said to get the cost of ordinary shares, the KE will be DO. Remember, in this case, the dividend, we've been told that they are growing at a constant what? Rate. And therefore, meaning that this is a constant dividend growth rate ordinary shares. So, under the constant dividend growth rate ordinary shares, we've said to get the KE equals to DO 1 plus G over PO minus the flotation cost, then you add the growth rate. So in this case, let's first look for the dividend. We've been told the most recent earning per share. We've been given there, and also we've been given the dividend payout ratio. We know dividend is paid out of the earnings. So for us to get the dividend per share, which will now be the last dividend, because we've been told that is the most recent. But if you are told that the next or the expected earning per share is that value, we'll now use that as our D what? D1. But in our case, what we've been given is the most recent. So is the one that was lastly paid. So in that case, the dividend per share equals to the earning per share. You multiply by the dividend payout ratio. So our earning per share is shillings 6. You multiply by the dividend payout ratio on additional information number 4, which is 60%. I will multiply by 0.6, which in my case, I'm getting 3.6. That is now the last dividend, meaning that now I can get the KE. KE will be equals to the DO, which is 3.6. 1 plus the growth rate on additional information number 4. We were told is 0.07. I divide by, on additional information number 1, we've been given the current market value. The current market value for the ordinary shares. Remember, this is on the cost of ordinary shares, which is 50. There was no flotation cost. Then you also add the growth rate. So what you get in here, is 0.14, meaning that you are supposed to multiply by 100% to get 14.7. That is on the cost of ordinary shares. The next one is on the cost of preference shares. The cost of preference shares. So for the cost of preference shares, the KP, we've said you take the D, P minus F, you multiply by 100. And how will you get the dividend? I said for the preference shares, they have a fixed rate of dividend. And when you get to the capital structure, you will get to see the rate that I'm talking about, which is 12%. So you take the 12% of the value, that is the issue price. So when I take 12% of 20, I'm getting 2.4. So meaning that now I can get the KP. I can now get the KP, which will be equals to the 2.4. On additional information number 1, we've been given the current price, which is that, minus 0, then I multiply by 100. And in that case, we'll be able to get a value of what? 8% as the cost of preference shares. Now the other one is on the debentures. So let's get to the cost of debentures. And in this case, remember, it is a irredeemable what? Irredeemable debenture. So to get the cost of irredeemable debenture, we've said to get the KD, you get the interest, 1 minus tax, you divide by the value of that debenture, minus flotation cost, then you multiply by 100. Multiply by 100. So in this case, the interest rate we've been given. So to get the interest, we just take that rate, which is 10%, we multiply by the value, which I said is also the nominal value. And we've been given in additional information number 2. We've been told that the nominal value was of shillings 100, and therefore in this case, it will be of 10 shillings. So in that case, this will be equals to 10. 1 minus the tax was 30. You divide by the current market value on additional information number 2, which is 120. I multiply by 100. And in my case, the value that I'm getting here is 5.83%. 5.83%. So after that, you also get the market values, because I've said in WSEC, we normally use the market values. And how will you get the market value? You have to get the number of shares, you multiply by the current market value. So I will begin with the ordinary shares. Ordinary shares. Now, when you check on the ordinary shares, we've been given the share capital. So first we have to get the number of shares. And how will you get the number of shares? Check from here. We are now when you check here, we have the ordinary share capital which were issued at 10 shillings, and the share capital is that what? Million. So to get the number of shares, we'll take the share capital, we divide by the value. So in that case, I will be able to take the 30 million, divide by the value, which was shillings 10, and then you multiply by the current market value, because I've said for the market value, they reflect the current market conditions. And the current market value on additional information number 1, which is also the PO, is 50. And when you multiply that with that amount, what you get in here is 150 million. We also have for the preference shares. You do the same. The preference share capital is of 5 million. I divide by the value, which is 20. Then I multiply by the current market value, which is 30. In this case, I'm also getting a value of 7.5 million. And the last one is the debentures. The debentures in this case is 15 million. You do the same. The value, which was also the nominal value, was 100. The current is 120. And in my case, I'm getting 18 million. So by that, you'll be able to get the total market values. And after getting the total market values, remember now, we are able to get the proportions. So the total market values in this case, we are getting a total of 175.5 million. So now in our case, we can now apply this formula to get the WSEC. Now to get the WSEC is the weight of what? The weight of ordinary shares, which is 150. You divide by 175.5 million. You multiply by the cost of what? The cost of ordinary shares, which was 14.7. You add the weight of preference shares, which is 7.5 million. I also divide by 175.5 million. You multiply by 8. And the last one is on debenture, which is 18,175.5. You multiply by the cost of irredeemable debentures, which is 5.83%. And by that, after you do your multiplication, you will be able to get 13.5%. And that is the WSEC on that part. The WSEC on that part. So you can screenshot on that question. You can screenshot, as we also do another one on the same case. We also do another one on the same case. Screenshot. We can now as well get to another question of the sitting of November 2016. November 2016. Question number 2B. And if you have any question, you can ask. Before we get to the next question, any question on the one that you've done? For the debentures, I've said already we were given the what? The debentures we were already, when you check on additional information number 2, we have the value and we have the what? So the same case you have done with ordinary shares is the same case you are doing with debentures. You get the debenture capital, you divide by the par value. On additional information number 2, we have the par value, which is on the nominal value. Then you multiply by the current value, which we've been given as 120. So let's just quickly move to the other one. That is November 2016, question number 2B. November 2016, question 2B. Hoping you can see now the question on the screen. Now, Sandy Limited presented the following extract of financial statement of financial position as at 31st December, October 2016. We have the equity, ordinary shares, we have the reserves, we also have the long-term liabilities, 4% preference shares, 1 shillings, nominal value. We have the 7% bonds, redeemable after 6 years. We also have the long-term bank loan. Additional information number 1. Ordinary shares of Sandy Limited have an ex-dividend market value of 47 shillings per share, and an ordinary dividend of 3.63 per share has just been paid. The following dividends have been paid over the first 4 years. Now, when you see such dividends, remember they are now helping us to get the growth rate. Now, the preference shares are not redeemable and have an dividend market value of 40 cents per share. The 7% redeemable bond is redeemable at 5% premium to their nominal value of shillings 100 per bond, and have an ex-interest market value of 104.5. So when you talk of ex-dividend, and we mean without dividend. When we talk of ex-market value, we mean without the interest. So in other cases, they can use the CAM dividend, meaning that is inclusive of the what? Of the dividend. Now, the bank loan has a variable interest rate that has averaged 4% per annum per year in the recent years. The corporate tax is 30%. So you are required the weighted average cost of capital, and you explain 4 reasons why the cost of equity could be greater than the cost of what? The cost of debt. Than the cost of debt. I will also be able to analyze on that. So now, in this case, the first thing that you need to analyze here, because we've been given the dividends, we have to look for the growth rate. We have to look for the growth rate. So let's first look for the growth rate. Now, remember, I said there are 2 methods that are used in computing the growth rate. When we were talking about the valuation of securities, when we were talking about the valuation of securities, we said that there are 2 methods that are used in determining the what? The growth rate. We have number 1 was the compounding method. We have the compounding method. And the number 2 was the retention ratio method. Now, on retention ratio method is when you have been given the return on equity and also the cost of what? Capital. When you have been given the dividend for the previous years, in that case, remember you are now supposed to use the compounding method. Now, in my case, we've been given the dividend for those previous period, I can now get the growth rate. And how do we get the growth rate? We said you take the end root of the dn over do, you minus 1. Now, in this case, we have, let me just analyze those years. We have for 2013, 2014, 2015, and 2016. For 2013, it was 3.09. And for 2016, it was 3.50. Because I'm only interested with those 2 years. This is now the DO. This is now the D. This is D1, D2, meaning that this is now the D3. So because of this D3 now, our growth rate will be equals to 3, the nth root of D3, which is 3.5, I divide by 3.09, then I minus 1. And remember, growth rate, when you talk of rate, is supposed to be on 100%. And in my case, we'll be able to get 4.24%. 4.24%. That is the growth rate. Now, once you get the growth rate, already we were told on additional information number 1, the last dividend that has just been paid. So meaning that we can now get our KE, which is DO 1 plus Z over PO minus flotation cost. You are the growth rate. So in our case here, the last dividend that was paid, we've been told that it was 3.63. 1 plus 0.0424. I divide by the current market value, which was 47. We don't have any flotation cost. We'll add 0.0424. When you multiply that, what we'll be able to get here is 12%. Now we also have the preference shares. You do the same. KP is the cost of preference shares, which we've said is D, PO minus flotation cost, you multiply by 100. So in this case, for the D, in the case of preference shares, I said, you take the rate of preference shares, you multiply by the VAR value, which is also the nominal value, which I will take the 4%, I multiply by 1. And in this case, it will be 0.04. So in that case, KP will be 0.04. I divide by the current market value was 40 cents, which is 0.4. I multiply by 100. And in that case, when you multiply by that, what we'll be able to get there, we don't have flotation cost. What we'll be able to get here is 10%. See 10%. When you multiply that by that, is it 10% or 1%? When I take 0.04, I multiply by 100, then I divide by 0.4, just 10%. So then the other one is the cost of debenture. Remember here we are having debenture. Listen, we are having a debenture. We are having the debenture and also having the what? The debenture and the loan. So I will begin with the cost of this debenture, which remember the loan and debenture, they are in the same category here. So in this case, this debenture was redeemable after 6 years. So meaning that this is a redeemable debenture. So we said to get the KD, which I also said is also the yield to what? Yield to maturity is equals to the interest 1 minus tax. You add the maturity value minus the value of debenture 1 over 2. Then you divide by the maturity value, the value of debenture, then half. And you multiply by 100 here. You multiply by 100 there. So in this case, The interest, you just take the rate. The rate that will be given there is 7%. And when you check on additional information number, additional information number 7, we can now be able to get the interest rate because we have the nominal value, which was 100. Number 4, additional information number 4. So our interest will be 7. Now we'll also have to look for the maturity value. If, like for example, here we were told that they were redeemable at a premium. So because of that premium, we have to look for the total maturity value, which will be the 105% of the VAR value or the nominal value, which in that case will be the 105. The value of the debenture will be given as 104.5. So by that now, n we know, and we can now get that. So we'll take the 7, 1 minus 0.3 plus maturity value, which is 105 minus 104.5. 1 over 6. I divide 105 plus 104.5, 1 over 2, then I multiply by 100, then I multiply by 100. So what I'm getting here, the value that I'm getting out of this, the value that I'm getting out of here is a value of 4.76, 4.76%, the 4.76%. That is the cost of that. Remember, this will be now the KD1. We also have the cost of bank loan. Which means that this will be now our KD2. Now, I want you to listen here. After tax cost of debt, which is now the KD, is always equals to before tax cost of debt 1 minus tax. So when you take on additional information number 5, the variable interest rate for the bank loan was valued at 4%. So in that case, it will be 4%, 1 minus the tax rate, which in this case, it will be 2.8%, which will be 2.8%. So now, we have now the cost. We are now remaining to get the weights. That is now we have to get the total market values. The total market values. I begin with the ordinary shares. Now for the ordinary shares, you take the total share capital, which is 800 million. I divide by the VAR value, which is 5. I multiply by 47, the current market value, which in this case, it will be 7520 million. We'll also have for the free franchise, which again is a total of 600 million. I also divide by 1, the VAR value, to get the number of shares, then I multiply by the current market value, which was 40 cents. So I also multiply by 240. We also have the debenture. That is the redeemable debenture. You do the same, which was a value of 600 million. I also divide by the nominal value. Then I multiply by what? The current value, which is 104.5. And in my case, I'm getting 627 million. The last one is the bank loan. In this case, this value is not changing, so will have the 200 million. And therefore, by that, you can get that value, the total market value, which is 85, 57, 85, 87 million, 85, 87 million. So meaning that together our WSCC in our case here will be WEKE plus WPKP plus WD1KD1 plus WD2KD2. That is for the bank loan. So in that case, we'll be able to have the weight of ordinary shares 7520. I divide, that is million, I divide by 85, 87 million. I multiply by 12. You add the free franchise again, which is 240. You divide by 85, 87 million. You also multiply by 10, the cost. You also add 627, the cost of debenture, the total market value. Then you multiply by what? What value? You multiply by 2.8. And the last one is on the bank loan, 2 million, 85, 87 million. You multiply by 2 point. This one is not 2.8. This was for the bank loan. So for this one was 4.76. So this 2.80 for the bank loan. And after you compute that, you'll be able to get this as 11.21%. That will be our WSCC. That will be our WSCC. So any question on that part? You screenshot on that part. And if you have any question, you can ask. If you have any question, you can ask on that. So in other cases, when they talk of CAM dividend, it means that it is inclusive of that dividend. And therefore, you are supposed to eliminate the dividend for you to get the current market value. If they talk of CAM interest, like for example, in the question of May 2019, they were talking about the CAM interest, the CAM dividend. Let me just show you, because this one I want you to do as an assignment. For the May 2019, they were talking about the CAM dividend and the CAM interest. The CAM dividend and CAM interest. The May 2019 question 3A. Now, when you check on that question there, we have the market value of the ordinary shares is quoted at shillings 45 CAM dividend. What it means that here, you have to eliminate the dividend for you to get the value, the PO, or the value of the ordinary shares. If you want to get the value of the ordinary shares, you have to eliminate the PO. So the same case to the interest, you have to eliminate that interest for you to get that value. So, the formula for what? The formula for the redeemable debentures, I've talked about it here, is also what we call the yield to maturity. The MP here I've said is the value or the maturity value. But the reason that we have changed our MP here, because the redeemable debentures were redeemable at a 5% premium. And this 5%, that is what I've included there to get the premium amount, to get that value. So any question on that part before we get to the other part of WMCC? So make sure that you do that question of May 2019 question 3A. May 2019, question 3A. Any question? Now, I'm talking about there is someone who is asking come dividend and also come interest. When we talk of come dividend, we mean the value is inclusive of dividend. And therefore, if it is inclusive of dividend, you have to eliminate that dividend for you to get the market value or the market price. So you have to get the dividend, you eliminate that value. Now, what you'll be able to get is now what we are calling the X dividend or X value, dividend market value without the dividend. You have to get rid of the dividend. Are we together? Yeah, that's how you are supposed to do that part. So any question on that? And remember, on the cost of capital is a mass question. In each and every sitting, you have to find a question in relation to that. When you check on November 2019 is what we've done. When you check on May 2019 is here. May 2018, November 2018, it was there on WMCC. 2017, 2018 May was there on WSCC and so forth. So in each and every sitting, you have to find this question. And there is always a question of 7 marks, of which you can as well get to those marks. And in other questions, you find that is having more than 10 marks. In some other questions, you find it having 12 marks, whereby you are, for example, looking for these costs. You find it having all those what? Questions. So let's just get to the other part, that is the weighted marginal cost of capital, WMCC, weighted marginal cost of capital. Let's get to that. I'm now on WMCC. WMCC, the weighted marginal cost of capital. The weighted marginal cost of capital. Now, when you check there, this is the cost of capital of new funds to be raised to finance a project. So it is used as the cost of capital when evaluating new projects. For the previous one, that is the WSCC, remember, or I've not answered the previous question, Roman 2. Let me just indicate, tell you on the previous question, Roman 2, whereby it was requiring you to talk about the what? The reasons why the cost of debt will be greater than the what? The cost of equity will be greater than the cost of what? The cost of equity will be greater than the cost of debt. Number one, remember, interest on debenture is a tax allowable. And therefore, in this case, it will reduce the WSCC. So when the company is being liquidated, remember, that is the first one. I see the interest on debenture is tax allowable, and that's why it will reduce the WSCC. Number two, when the company is being liquidated, I mean, when you are winding out the company, the debenture shareholders are the first people to be paid. Remember, for the ordinary share capitals are paid later. This one you must be aware of it when you've been talking about the partnership, the dissolution of a partner. There are those you start by paying the debentures as you move forward to come and pay the ordinary share capital. Now we also have the number 3, whereby the debenture shareholders normally earn a fixed rate of dividend. And in the case of ordinary shareholders, remember, the dividend normally varies because it will depend on the amount that has been declared by the directors. So in this case, it will make the cost of equity to be higher than the cost of that debt. And those are the three differences that you can give in such case. Now, I was talking about the WMCC, whereby in this case it is used when you are evaluating what? The company's new projects. So the point that our financing where a given source of finance is exhausted, so that the investor can use the next source of finance, is what now we call the break point. And how do you get the break point? Is also what we call the critical point. You get the amount to raise, you divide by the weight. Now, in this case, when you are doing the WSEC, the only difference with the WMCC and the only difference between the WSEC and WMCC is only that for the WSEC, we are including the what? The retained earnings. Reason being, we are not using the market values. In this case, what we'll be using is now the amount that you'll be raising in a given source of finance. So for this case, to get the WMCC, it will be equals to WRKR, that is the weight of retained earnings. In this case, you have to include the retained earnings, because what we'll be using as will not be using the market values, we'll be using the amount to raise. So you get the weight of retained earnings, the cost of retained earnings, weight of equity, cost of equity, weight of debenture, cost of debenture, weight of preference shares, cost of preference shares. That is how you get that. And this is, remember, the only difference is here. This one you are including the flotation cost. This one you are not including the flotation cost. So we can just quickly do an example in regards to the MCC in regards to that. So we can do a question in the sitting of November 2017, question 3. Question in the sitting of November 2017, question number 3. November 3B. November 2017, question number 3B. November 2017, question number 3B. Can now see the question on the screen, whereby Ray Properties Limited is planning to build a business mall. The project will cost 180 million. That is now the amount to raise, 180 million. The firm's current optimal capital structure is as follows. We have for the ordinary shares, we have the 10% for debt, retained profit. Additional information, we've been told the firm will issue a new 15% debenture at shillings 120 each, with a flotation cost of shillings 10 per unit. The value of the debenture is shillings 10. New ordinary shares will be issued at a current market price of 30 shillings each, with a flotation cost of 5 per share. The most recent dividend paid by the company was shillings 5 per share. So that is the last dividend. The company, the dividend is expected to grow at the rate of 5% per annum in perpetuity. The firm expects to retain shillings 18 million to finance this investment. So meaning that already we have the retained earnings. Now the corporate tax is 30%. You are required the amount to be raised from the equity capital if the capital structure is to remain unchanged. And I said when we talk of capital structure, they are the long-term sources of finance employed by the entity. So in this case, this company is employing only the ordinary shares, the debentures, that is the debt, and the retained profits. So using this value, you are required to look for the amount to be raised from the equity capital. Number two, you are required to look for the number of shares the company should issue to raise the desired external equity capital. Remember, for you to get the number of ordinary shares, you have to get the total share capital. You divide by the issue price. Now, the firm's weighted marginal cost of capital is what will be required in Roman number 3. So let's see how we go about with that question. How to go about with such a question. Now, in this case, on number 1, we are required to look for the amount to be raised. The amount to be raised. And in this case, is from equity. The amount to be raised from the equity. Remember, equity, as said in this case, comprises of the ordinary shares and preference shares. Not preference, but the retained earnings. Sorry, the retained earnings. So in our case, we'll first based on the ordinary shares and the retained earnings. So first we know when you check on the existing, because we've been told that in this case the capital structure is not to remain unchanged. So when you check there on the ordinary shares, we have a value of what? So let's get the total equity, which is 480. You add the retained earnings, which is 96,000. And in that case, you divide by the total capital structure. In this case, remember, we want to know the rate, that is the proportion of the equity before it was changed. So remember, in that case, I've said for the equity, we are taking the two, that is the ordinary shares and what? Retained earnings. That's why I'm taking this value for the ordinary shares and retained earnings. I divide by the total value, and then I multiply by 100. In that case, it will be able to give us the proportion of the equity, which in this case it will be 60%. So the amount that went to the equity part is 60%. So to get that amount for the equity, it will be 60% of the total, because we want to know the amount that will be raised. And remember, the amount to be raised is the total project cost, which we were given on the first paragraph, which was 180 million. So meaning that when you take 60% of 180 million, you just get 108 million. And that is the amount to be raised from the equity, 108 million. Now, Roman number 2, you are required to look for the number of ordinary shares. Already, we know the equity, total equity here is 108. And in this case, this equity is comprising of what? Is comprising of the ordinary shares and retained earnings. So what will be the value of the ordinary shares? We have the value of the ordinary shares and also the value for the retained earnings. Now, which should be able to give us 108. Now, for the value of the ordinary shares, in this case, for the value of the retained earnings already we've been given. Because when you check on additional information number 5, the firm expects to retain 18 million. That is now the retained earnings. So if it is retaining 18 million, the value that is remaining here, the 90, is now for the ordinary shares, which is now giving us the total equity capital. Now we have the ordinary share capital, but in our case, we want to get the number of shares. So how do you get the number of shares? Number of shares. Now, to get the number of shares is the amount to raise from what? The ordinary shares, which is this 90, and you divide by the issue price. You divide by the issue price, which I will take 90 million. I divide by the issue price. And when you check on the issue price, on additional information number 2, the number of ordinary shares will be issued at a current market value of what? 30. Meaning that 3 million shares will be issued in order to raise what? That share capital, 3 million. That is on the Roman number 3. Now, the other one is Roman, that was Roman 2, Roman 3 now. Now on Roman 3 is WMCC. Now to get the WMCC, in this case I've said, you are now including the weight of retained earnings. Cost of retained earnings, the cost of preference shares cost, because we don't have preference shares, we only have the debentures, so those are the debts, so we'll have those 3. So meaning that I will start by looking the cost of what? Retained earnings, which will be equals to DO 1 plus G divided by the PO. This case, remember, retained earnings do not incur flotation cost. So we'll not less that. Then you add G. So in our case, this one will be equals to what? The cost of retained earnings will be equals to 5. We have it here, 5, 1 plus the growth rate is 5%, 0.5. You divide by the current market value, which was 30, you add 0.05. So by that, in this case, what we'll be able to get there is 22.5%. 22.5%. Now also we have the cost of ordinary shares, which in this case we've said we are incurring the what? They are incurring the flotation cost. So in that case, I will take DO 1 plus G. You divide by PO minus flotation cost, you add G. The only difference with this one, you are lessing flotation cost here. So here I will have 5, 1 plus 0.05, divide by 30, minus flotation cost in our case, on additional information number 2, we've been told that it was incurring a flotation cost of 5. Then I add 0.05. So in that case, we'll also be able to get the value for that, which in that case will be equals to what? Will be equals to 26%. We also have the cost of the debt, the KD. And when you take in our case, this was a redeemable debt because we've not been given the maturity value. So in that case, what we'll do, we'll take the interest, 1 minus tax, you divide by the value of the debenture, you minus flotation cost, then you multiply by 100. So to get the interest, I said you take the rate, you multiply by the value. So I will take the 10% of 100, 1 minus 0.3, then I divide by 120, which was the current value. And when you check on additional information, number 1 again, we've been given the flotation cost of 10. So in this case, that one will be 6.4%. 6.4%. So now the last part now is to get the what? WSCC. So we have to get the weights. So in this case, I've said we'll only focus on the amount to raise. The amount to raise. And already we know for the retained earnings, we know for the ordinary shares. What we don't know is for the preference shares. So for the ordinary shares, we know they will issue 3 million shares to get a share capital of what? 90 million. For the retained profits, they will retain how much? 18 million, as we've seen. Now for the debt, it will be now the balance, which in this case is how much? Remember, the total amount to raise is 180 million for the project. So the balance in this case will be equal to how much? Or else you can now get to the that capital structure, which is having 384. Take 384,000, you divide by 960, then you multiply by 180. What you get there is now the balance here, which in that case is 72 million. You can do this, or you can either decide to eliminate it from there. So now we can get the WMCC, which will be equals to the weight of equity, the ordinary shares, which is 90. I divide by 180. Then you multiply by the cost of equity, or the ordinary shares, which is 26. You add 18 million. You divide by 180. You multiply by 6.4%. And also the last one, 72 million. No, this is not 6.4. This is for 22.5%. And for this one is for the equity, or for the debt, will be equals to what? 6.4%. So how much will you get from there? How much will you get from there? So after you compute on that, the value for the WMCC, will be 17.81%. 17.81%. Remember, when you are inputting in the calc, you don't use the rate, because once you use the rate again, it means that once you get this value, you multiply by 100. But in our case, we just use the 26, 22.5, 6.4. You get that. Once you get that, you multiply, you just put the percentage, because already this is on percentage. So that is how you are required to do on regards to the WMCC. I say the only difference in this case, you are including the what? The retained earnings. Because in our case, I've said we are considering on the amount to raise. So you can screenshot on that. You can Can screenshot on that. So by that, you'll be able to do the following questions as assignment. Be able to do the following questions as assignment. I will begin the one for the May 20, the one I began by giving you was May 2019 question what? Question 3A. We'll also be able to do May 2018, that is on WMCC. So May 2018, that should be question number May 2018 on WMCC, question number, yes, that is question number, not May, but November 2018. November 2018 on WMCC, question number, yes, that is question number 4B. Be able to do that. Also, we'll also have for May 2014, question 4B. Not forgetting May 2018 again. We have been so many questions on regards to this subtopic, which I've said that this is a very examinable part. So December 2014, question number 4A, question number 4B. Yeah, you do that and you remit those assignments. I've realized also there are some of you who are not remitting those assignments. And I say, and I will keep repeating, make sure that what we've done, you understand by going through the assignments. And after you do the assignment, in that case, it will be well with you. Anybody with any question? Anybody with a question? Anybody who is having question? Yeah, those ones are for the yeah, on come interest and come dividend, I think I've explained. So for those one, I know you are now aware of that. Anybody with a question? Charles, you are okay? Okay, we have George. George, you are okay? So if there is no question on regards to that, if there is no question on regards to what we covered, then I think we can now, in our next class, I'll be able to talk about the rights issue and also on the riverages, on the rights issues and riverages, which is also another part that is also examinable. So we'll talk about the rights issue, riverages, and also the point of indifference, which is also under the cost of capital. We'll be able to analyze on that part. And once we analyze on that, I think the rest other topic that will be remaining for us is on working capital management and also on the capital budgeting. And then we'll also be able to go to the other part. So for the notes I will share to you, or those notes, what I've just tackled, I will be able to send to you for you to do or to revise on your own. So if there is no question, let's just meet in the next class.